It is disappointing to see such an anemic bounce off of what was an oversold condition back in June when we had that absolute bloodbath in energy trading. And we had really hoped to see a more powerful rally because that would have told us that the uptrend is still intact. And so right now we have to keep energy on a really short leash, because if we continue to have these anemic rallies and bigger down days, it would tell us that we need to be more inclined to be sellers of rallies instead of buyers of dips. And that would be indicative of a market that's going from favoring late cycle cyclicals to favoring late cycle defensives like healthcare, as Adam mentioned. Because if we think of the defensive sectors, the thing that healthcare has is that it's actually the cheapest of all of the defensives. It's trading at 18 times in aggregate. That compares to 21 times for both staples and utilities. So that screens well. It's counter-cyclical. It is rather defensive. And we think that the market is slowly starting to shift in that direction.
Peter, it's tough to look at the action today and really read into it as anything but the playbook for, okay, let's get ready for a recession pretty much across all asset classes. Anything in there that you want to either fade or feel as if it's already kind of in the books, or you pretty much say, yeah, that's the way to play it?
Yeah, I think, it's great to see you, Mike. The sort of dual analog we've been using, some combination of late 2018 into early 2019 relative to QT, and relative to inflation, which we were on sort of early, the 1970s. And so if you think about what happened in the 1970s, particularly relative to the oil shock, which is, in fact, not within the Fed's control or anyone else's for that matter, except perhaps Putin's, we're likely going to see something of a more significant drawdown. Now, I think what's interesting, along the way, you get some considerable bounces. And I actually think we're in store for one of those. Breadth for both the NYSE and the S&P fell considerably about 2-3 weeks ago. I think for the S&P, only 20% of the stocks in the S&P were above their 50-day. And for the NYSE, it was about 20%. Were above their 200. And every time that happens, even in the depths of a sell-off, you tend to get something of a rebound. So I actually think we're going to see an expansion of breadth, and some of the beaten down sort of value cyclicals are going to get a little bit of a bid here. But it's clearly still a sell the market rally. And outside of equities, which I think is important to mention, they're not the only game in town. We're a structured product specialist with a penchant for, multifamily, and we have an interval fund that investors can buy. And that tends to be a very defensive place to be in the kind of economic environment that we foresee.
Cameron, Peter talking about some historical analogs. If you look at just some of the momentum, the positioning, the tactical indicators, whether it's two straight 10% down quarters, it's how some of the sentiment readings have looked, a lot of the stuff that shows you the magnitude of downside we've had in a relatively short period of time. A lot of the historical pattern work says, well, generally that improves your forward returns unless it's '08 or unless it's '02. In other words, unless it's kind of a multi-year, compound bear market with a significant corporate recession alongside of it. Would you say that that's the binary we're looking at right here, or is there somewhere in the middle that we might be occupying?
Well, you said the most operative word, which is a corporate recession or some kind of debt crisis. That really is the arbiter between, do we have a kind of drawdown that looks to be in that 30% range, which is the average for recessions, or something that looks closer to down 50%, which is what we saw back in the early 2000s in '08, where we had two debt crises. And so if we don't see a debt crisis, we think that we could start to find some value around that 3,400 level, because that's what gets us back to the pre-COVID highs. We will have round-tripped all of this COVID froth. We could undershoot from there. That's still very possible. As you mentioned, if you look at some of these shorter-term indicators or breadth and things like sentiment, yes, they do look rather poor. But if we look at positioning, it still remains really long. All year long, we've been saying we need to watch what investors do, not what they say. We've been bearish all year on that AAII sentiment survey, and yet people haven't been selling. They're just starting to sell, but they're still at about 65% allocation to equities on a retail side. That went down to 45% back in the 2000s and '08. So there's likely some more selling to happen, some more shaking out to happen, really before we can find that really meaningful bottom. But once we get to that 3,500 level, we look out a year, 2 years, we think even if that's not the ultimate low, we're creating some really interesting value there.
Yeah, I mean, 35 is also, Adam, exactly unwinding half of the rally from the low in 2020 to the high that we just got in January. So, I mean, there's a lot of reasons to think that has some gravitational pull. But what's your thought on how we should be thinking about putting this in context of history? Well,
we studied 100 years of daily returns for the S&P in a recent note. We've had 25 sell-offs of 10% or more, 7 of 30% or more, peak to trough. So the 3 in our kind of investable lifetime, which were, TMT, financial crisis, and COVID, I don't think we're set up for fear about an earnings collapse, the magnitude of those 3. So mentally, I was sort of thinking 30% or more would be kind of a lot. And, the hard part for us is going to be the multiple. But I don't think we'll get there. So maybe that means 10% more down and 30% more up over a couple-year view. And that's probably the risk reward. But I just don't think you want to buy individual stocks when they're about to guide down massively. I need some evidence that they won't. I'm not as much of a fan on the short-term calls around bull bear and stuff because it's hard for me to assign predictive value to that. So I think the sentiment is always a little bit trickier to get at. I think we look out, 12, 18, 24 months, the market will be higher.